Hello, friends. Welcome to Block Bytes. Recently on crypto Twitter, there has been a raging debate about low float and high FDV tokens. As someone new to the topic, I first wanted to understand what low float and high FDV mean. So I did some reading and created a Twitter thread, which I posted on Monday. In this video, I will discuss my findings and my opinion from that thread. Let's start. What does low float mean? Float represents the number of tokens added to circulation during a product launch. You can find this quite easily by going to a website like Token Unlock, enabling the vesting schedule, and going back to the launch of a token to find its circulating supply at launch. A vesting schedule is a timeline that specifies when and how many tokens will be released from a project's total supply. Token unlock refers to circulating these tokens according to the vesting schedule. A low float means a token launch with a relatively low circulating supply compared to its total supply. Now, FDV stands for fully diluted value. FDV is simply the product of the token's price and maximum supply. It is an indicator of the project's potential market size or value. Some tokens have an infinite amount of token supply. In that case, the FDV is calculated based on the total token count, which is usually more than the circulating supply, as there could be more tokens present than those actually in circulation. Let's understand FDV with an example. The FDV of Solana is, or the FDV for Solana at $183 per token is more than $105 billion for a total of over 576 million tokens. Ripple or XRP, on the other hand, has an FDV of more than $54 billion at a price of half a cent and a maximum supply of 100 billion tokens. Now, FDV only gives you a little information about a project or token, but it shows how the market values the project at the time. For new tokens, the FDV indicates that the project team and its sponsors or promoters want the market to value it because the project has yet to be subjected to market forces. A high FDV means that the project thinks it is worth more than some of the other projects. This could be a contentious issue, as who decides what a project is worth? At the launch, the team and its promoters clearly have a financial motive. So why is this a problem? The debate started with this recent report released by Binance. It goes into a fair amount of detail, presenting that 2024 has already seen more low float and high FDV token launches than previous full years, and then citing some examples to explain this phenomenon. Let's look at what the report presents. It starts with this chart. According to this, the average float over FDV ratio of the tokens released in 2024 has been the lowest compared to previous years. This means that their market cap or float is not only low, as represented in yellow, but their FDV is higher, represented by dark brown, than in previous years. One of the implications of such tokens is that since they launch with a low float, they will unlock significant amounts of token in the future, as we have seen with vesting schedules. The problem with this is that unlocking large portions of tokens dramatically increases the supply, which reduces the price of these tokens. As an investor, you will see a price drop leading up to or after the unlocks. The report gives several examples of such tokens in this chart, clearly showing the number of tokens released at launched and locked. At the same time, these tokens also have high FDV. which, as we now understand, means that the project values itself much higher in the current market. This markup is quite dramatic, as shown in the following chart. Some tokens were close to the average FDV of the top 10 crypto projects at their peak price. Common sense suggests that no new project can come close to the average of the top 10 projects, which have spent years under the scrutiny of market forces. Market forces refer to the supply and demand dynamics that influence the price and value of a token. However, we still see projects that think they are close or even better than some of the OGs in the space. Let's recap all that we have learned so far. Low float means a low circulating supply at launch, and high FDV means high valuation at launch. As shown by the ratio, 2024 has been worse off compared to previous years. This means that retail investors will have to face massive token unlocks going forward, which will drive the price downwards. The high FDV will get trimmed down, most likely when the project is subjected to market forces again, impacting retail price expectations. Therefore, retail investors must stay informed, be cautious, and consider these factors in their investment decisions. So, what, according to the report, are the key reasons behind this? The most crucial factor is increased private capital funding of these projects. Since the third quarter of 23, we have seen a steady increase in private funding of crypto projects. As more funds flow in, more VCs compete with each other for the same projects, raising valuations, and the projects will choose whoever is willing to provide the highest valuation. This creates a vicious circle of competition, inflating valuations, where the other projects start raising their FDV, expecting the same, resulting in more competition and deals. This cycle continues until the market forces come into play and the valuations are adjusted. The following chart shows this increase in deal making. The number of deals in the first quarter of 24 jumped by over 52%, the highest in last 2 years. The main reason for increased deal making is the bullish market trend. VCs want to avoid being seen sitting on loads of cash in such a positive market condition. The projects know this, hence, they also inflate their valuations. This increase in valuation is shown in the following chart. Again, we see that in quarter one of this year, projects were able to raise more money for less dilution. The charts caused quite a reaction on crypto Twitter, dividing people into two groups. One group slammed the VCs and the projects for creating a culture of using retail as their exit liquidity. They argued that this practice is unfair to retail investors, who often bear the brunt of price drops due to token unlocks. The second was the VCs and projects trying to rebut the report by presenting their take. They argued that high FDV reflects the project's potential and that retail investors should see it as an opportunity rather than a threat. Both sides made valid points, but I must speak for the retail user and investor as a retail investor. So I have compiled a list of takeaways from this entire saga. First, if you are interested in a token, study its token vesting and token unlock schedule. This will give you an idea of what to expect in the future. Second, use intelligent dashboards like DYOR's VC printer, which clearly shows a VC's level of influence in a project. You can use this information to make your decision. Third, keeping all metrics and market forces aside, a token with high float and low FTV is better from an investment point of view to one with low float and high FTV. Fourth, look for tokens that have not raised VC funding and are fair launched. Fair launch tokens do not allocate a percentage of their tokens in return for funding from VCs. Everyone can participate in token mining from the start. Examples include Bitcoin, BitTensor, Com.ai, and several others. Fifth, meme coins have suddenly become a good investment. This is partly because they do not have any VC investment or unlock. So start looking into meme coins. Even traditional finance is doing that, so you're not alone. I will probably cover this last point separately in a different video because knowing about meme coins and how to use them wisely as investment vehicles is essential. So that is it, folks. I hope you like this video. Do like and share, and I will see you next time with another fresh bite. Bye.